80s and David Ryan. David was a three-time winner of the U.S. Investing Championship in 85, 86, and 87. He was a former longtime PM here at William O'Neill and Company, and then he left in 1998 to start his own hedge fund. He was featured in the Market Wizards book, the original, the first one. And here's one of the first stocks that he bought in the investing championship was Franklin Resources, and he bought Ben crossing above this downtrend line out of this base. You might see us on IBD Live. I know some of you mentioned you are on IBD Live, and we draw these downtrend lines a lot to help us get into names. There's a yin and a yang. I like to use it, but it can force you, or it can cause you to have to try a couple of times, because drawing the line is there's no perfect math to drawing the line. You kind of can draw it any way you want. So that's how he bought Ben. It ran up. It built a flat base. He bought more, and then he sold it. He liked to sell them, at least initially back then. He liked to sell them on the way up while the getting was good. I can't remember where I heard it, on one of the tapes that I have of of Bill at the seminar. I have these old seminar tapes where him and David used to go around. And Bill said, well, David would buy something, it would go up 20% and he'd sell it. He'd buy something else, it'd go up 20, 25% and he'd sell it. And then he goes, pretty soon he'd done that 6 or 7 times and he was up 100%. And so it wasn't quite that easy, of course, but that was kind of the process to how David would win these championships. He would, Ben Franklin might go higher, but he there's another name that he wants to move the money in. So he's taking his profits. So he sold some on the way up, and then some when it broke badly on this week. Here's Toll Brothers in March of 1987. He bought this one a little late. Admittedly, he said I missed it out of the base, but he bought it breaking out of that kind of, it's kind of like a cup with a high handle. So he bought it in that, in the high 13s area, and then he just sold it on the way up. 13 to 30 is a ton of a move. That's a huge move. Sure, it can go higher, but he's got that capital to move into another name if he wants. And here's Microsoft in October of 1987. So he bought Microsoft, breaking that kind of downtrend line there. He bought it again as it started to rally, not quite off the 10-week line. Then it built a flat base, and it ran up 50% out of that flat base. He sold some on that week and then felt like, I think I made a mistake. He bought it back, and then it ran up some more. He sold some more again, and then it built the cup with handle. And I apologize, when I said he sold some here, I don't know if you can see my mouse, but he sold some in that kind of consolidation, realized that, I think stock's going higher, better buy that back. And then when it went higher, he sold before this cup with handle. Did he know it was going to build a cup with handle there? Of course not. No, he just was taking his profits on the way up. Stock built a base and he bought it back, right? You can do that. So if he sold at 50 and he had to buy at 60 out of the cup with handle, it doesn't matter. If he thinks Microsoft's going higher, he's going to buy it back at 60. But it ran up 30%. It looked like it was going to get going, but then it had a bad break and he sold it. So this is what the daily looked like. So he bought it out of this cup with handle, and then he sold it up there a number of days before the crash of 87. So did he know the crash of 87 was coming, right? No, but he just was reading the market and reading the action in the stock. Now, Microsoft was acting okay. It wasn't really doing anything wrong before the crash, but the overall market was causing him to be tepid in his positions. You can see the NASDAQ really breaking below the 50-day, a number of distribution days, and he sold Microsoft on that day due to the weakness in the overall market. Here's a more newer name, Generac, which is they make the generators. So he bought the pullback in this stock, and then sold it and held 20% of his position. So this, and David's been on Arusha's podcast a number of times. He's done webinars for us. A lot of these slides are from the Cancelam Masters workshop that he did for us. He was a guest last year, so you can kind of revisit some of his thought process now on how he's trading. And so he sold some. He likes to hold some of it, like what he would call his core position. So he sold down to his core position and he just lets that one ride, right? So he takes profits if the stock gets going and then tries to keep a core position for a much larger move. So here are some of my favorite quotes. One thing that really I always remember what David would say, because I like to buy stocks that have doubled as they tend to double again. That's my favorite that he says, because it's so true. How many times has Home Depot doubled? Microsoft, Amazon, Google, PayPal, Apple. I can go on and on, right? So you don't want to buy them after they've doubled. You want to let them build a base, but you should never be afraid of a stock that's doubled, right? The game could just be getting started, right? And it's harder. There aren't that many stocks that do that, but they're out there. The RS line is his favorite technical indicator. I always hear him talking about the relative strength line when he's buying and or selling, if he's considering selling, if the stock is weaker than the market. David's a great guy to listen to, very humble. He's had tremendous success, but he doesn't wear it on his sleeve, so to speak. He goes, I always like to stay positive, stay humble, be flexible, change your stance. It's okay to say, you know what, I was bullish XYZ today. Something's wrong. I'm out tomorrow or a week later. It's really hard. There's a lot of ebbs and flows in the market nowadays. So you're probably going to have to be more flexible than usual, but it's okay. It's okay to be flexible, to change. Keep it simple. He doesn't use any MACDs, crossovers, you name it. I don't think you'd have to ask him, but I would be shocked if there's a technical indicator that he uses. He just says it's easy to see the trend if you're objective, right? If you just can kind of step away from it. There's a great quote from one of the Market Wizards books where one of the guys, Jack Schwiger, asked the guy how he knew where the trend was, and he said, easy. He goes, if I throw the chart book on the floor and stand on my desk and just look at the chart, it's going to tell me where the trend is. So sometimes it really is that easy. You have to do the work. This is not an easy game. It's gotten a lot harder because a lot of the smartest people in the world go to Wall Street. So if you got a PhD in physics from MIT, there's a chance Goldman Sachs might knock on your door and try to hire you. So it's gotten tougher because of that. But we have a few advantages that they don't have: the ability to be flexible, to change, to ebb and flow with the market, to be 50% invested if we want. To be 0%, to be 200%, right? So you have a lot of flexibility that some of the institutions don't have. He says in Market Wizards, he said somewhere in here, and he pointed to the chart book, because that's how we used to look at them. We used to get these chart books delivered to us. There's going to be a big winner. And I think the same thing every Sunday when I look through the Growth 250. I just think somewhere in here there's a big winner. I gotta try to find it. I know there's a big winner in the Growth 250, and probably more than one. And it's just a matter of finding it, right? And just go backwards. Think about looking at all the stocks that have made big moves. They were in our lists before. It was just a matter of finding them and trying to hold on to them as best we could. Okay, so let's jump to William J. O'Neill. Most of you know, but he's a former stockbroker. He founded William J. O'Neill and Company in 1963 after a handful of huge winning trades. Started what used to be Investors Daily in 1984. Scott O'Neill actually added the word Business Daily a number of years later because the paper was really more for investors initially. It was kind of a spreadsheet of just price and volume action and stocks, et cetera, highlighting unusual action, and then they kind of moved more towards business as well. So Bill started IBD with the profits from the market, and he supplemented IBD for a lot of years with market profits. He was also featured in the original Market Wizards book. So here's one of his first big wins, Chrysler in 1963. You can see the cup with handle that it's building. And he said it had a big sharp shakeout because the general market was selling off. So what was happening at this point when Chrysler was building the handle was the Cuban Missile Crisis, right? And with Russia, the warships, most of you probably have heard the story or seen the movie. I think it's called 13 Days with Kevin Costner. It's been a long time since I saw that, but that was a really good movie from what I remember. And so there was a lot of fear, right? And so the market was getting hit, and Chrysler got hit, but then it came back, right? It was really strong. The market was anticipating that this would ebb and this would pass, and Chrysler was one of the potential big winners. You can see that nice little shakeout in the handle. And Bill bought it coming out of this cup with handle. He says, it's probably my first big winner that I bought off of a chart. He goes, he bought it because of the chart. And later on, he says, I was talking to both of those people. They had been buying at the same time. And the quote was too large for me to include in the screenshot. But what happened was later on he met with Gerald Loeb, who wrote The Battle for Investment Survival, one of the books that influenced Bill, and a fund manager from Fidelity. And they both said that we were buying that day. So they were all buying Chrysler, and not knowing, of course, but they were all buying Chrysler at the same time that day as it was coming out of this pattern. And that happens a lot in-house too. My favorite story is with Chipotle when I first started, and Scott O'Neill came out and said, it was on a follow-through day in 2010, when I first started, late 2010, and he said, we're buying Chipotle. And it was coming out of a cup with handle, and he used the word we, which stuck with me. What he meant was all of the portfolio managers were buying Chipotle. All of the portfolio managers, they don't sit together. We had a guy that was at home. We had Mike and Charles and Wendy were down the hall by themselves. And Scott was the head of Market Smith, and I don't know where Bill was probably home. And they were all doing the same thing. They all saw the same thing. So that can happen a lot. When I heard Bill say this about Chrysler, it reminded me of Chipotle. And he said, I sold that stock to buy Syntex, a lot like what Darvis would do, right? His stock makes a big move. It might go higher, but it might need to rest. And he wanted that capital for the next name. And here is Syntex, and it's a little scrunched. It's hard to see the high tide flag because I wanted to include the fundamentals across the bottom. You see the huge fundamentals. Syntex, I don't know if they invented it, but they marketed the birth control pill in the 60s. So they had huge earnings and sales. You can see that across the bottom. Stock ran from 15 to 35, then built